Hi, Else here, and in the previous set of videos, we completed the issuing of shares, cash dividend, stock dividend, and the statement of changes in equity. What we're now doing is a question that will have share repurchase as well as the calculation for earnings per share. We're going to continue on with Greene Corporation, but this time we're going to be doing 2017. The question is available for download. Please check my Dropbox. Make sure you've downloaded the question before I solve it. To even have a better learning experience, attempt the question yourself first and then watch the videos to see if you're correct. Let's look at the question. Greene Corporation has been provided for December 31st, 2016. You'll notice that this is the shareholders' equity section of the statement of financial position, also called the balance sheet. All the information has been updated for the current year end, December 31st, 2016. In 2017, the corporation had a number of transactions. They include issuing 25,000 common shares in order to purchase land. We also declare a semi-annual preferred share dividend, and then we repurchase 7,500 common shares. At the end of the year, we're going to declare the semi-annual preferred dividend again, and at December 31st, we know that the net income or profit is $192,460. We have to show the entries for 2017 and calculate the earnings per share for 2017. Let's get started. The first thing that's going to happen is we're going to create all the shareholder equity T accounts, and we're going to input the opening balances. Remember, for all the preferred shares and common shares, we're going to include the number of shares. Let's start all the entries. First, we purchased land in exchange for common shares. Notice that we have two values. 25,000 shares at $25 each is equal to $650,000. But we also have the land value. We know that the fair value is $698,000. The question is, which value do we use? Often students do a very strange entry. I'm going to show it to you. Please don't write it down. It's the incorrect thing to do. They debit land for the amount of the value of land. Then they credit common shares for the value of the common shares. And then they credit again for the difference. This entry is unbelievably incorrect. There is no such thing as a gain. Both IFRS and ASPE require companies to use the value of the asset received unless that amount is not determinable. If that amount is not determinable, you can use the value of the shares given up. The value of the land here is clearly given. This is the fair value of the land. It is determinable. Because it's determinable, we must do the entry using the fair value of the land. Therefore, the entry is as follows. February 1st, what did we receive? We received land. We know the fair value of the asset received, and therefore we must use it. What did we give up? We gave up common shares. The value of the common shares is equal to the value of the land. Keep in mind that we use the value of the land because the value of the land was determinable. If the value of the land had not been determinable, we would have used the $650,000. Let's move on to the next entry. On June 1st, we declare a dividend. You already know how to do this entry due to past videos, so I'm quickly going to run through it. On June 1st, the date of declaration, we're going to recognize that there is now a liability. The amount of the liability, number of shares outstanding, multiplied times the dividend for the preferred shares, multiplied by 1/2 because it's a semi-annual dividend, 13,200. You'll notice that I forgot something. I've forgotten to update the T accounts. That is a very bad thing to do. Let's just pop up and update the T accounts for all the entries that I've already made. Land, of course, I haven't got one, but I'm going to create one right now. And the entry for land would be 698,000. And then common shares are going to go up by 698,000. And the number of shares that we actually gave up, 25,000. In addition, the dividend is going to reduce retained earnings and dividends payable, which I'm not tracking. Let's pop back down to our entries. On June 18th is the date of record. We know that on the date of record, there's no entry. And then on July 1st, we pay the dividend and we give up cash. No update of the T accounts that we have is necessary. Let's move on. We're now at October 1st. We repurchased 7,500 common shares at $26.25. There's some steps that we have to go through. First, we have to calculate the book value per share. If we're repurchasing shares, we have to eliminate the value from common shares. Let's look at our T accounts. We know that right now we have 351,095 shares outstanding. The value of those shares is 8,064,147. We have to calculate how much each share is worth. So let's do that. Book value per share is equal to the total value of the shares divided by the total number of shares. That means that each share has a book value of $22.97. On average, that's what everybody paid for the shares that we sold. When we repurchase shares, we need to use the book value in order to calculate the reduction in the value of the common share account. We're repurchasing 7,500 shares. Multiply times the book value tells us how much the common share account is going to decrease by. But that's not the amount of cash we pay. We're going to pay a different amount of cash. 7,500 shares times the amount we paid for the shares on the open market. In this case, $26.25. That means we're going to have an outlay of cash of $196,875. Notice that there's a difference here. Let's start the entry. This is on October 1st. Common shares are going to be reduced by the book value. We debit common shares for $172,264. The amount of cash that we actually have to distribute to the shareholders is $196,875. Under normal circumstances, in order to balance this entry, we would put a debit to retained earnings. But we happen to have something else here. We have contributed surplus, which is due to repurchase of shares in the past. When we have a contributed surplus, we must always use up the contributed surplus before we take anything out of retained earnings. Because we have contributed surplus, we are going to use contributed surplus. Therefore, the debit will not be to retained earnings, it will be to contributed surplus. The amount, the difference between these two, which is $24,611. Keep in mind that if we did not have contributed surplus, this would have been a debit to retained earnings because the book value is less than the cash value. We have to have that value from somewhere else. I'm not going to say the word cash because it's not cash. We are simply reducing the wealth that is due to the shareholders by the amount of additional cash we had to pay for the shares that we repurchased. Generally, that would be retained earnings, but because we have a contributed surplus from past repurchases, we have to eliminate the contributed surplus first. Let's update our T accounts. Going to reduce the contributed surplus by the $24,611. Reduce common shares by the amount of the book value. In addition, I have to reduce the number of shares by the amount that we've actually repurchased. Finally, retained earnings is going to be decreased. Cash would be decreased. I don't have a cash T account, so I can't do that part of the entry. Let's move on to the next part of the entry. We declare the semi-annual preferred share dividend. We've already done this in the past, so I'm just going to rush through it. December 1st, date of declaration. December 20th, date of record. No entry. December 31st, date of payment. Update my T accounts. I have no other T accounts that will be affected. At this point, I want to create a total for all my T accounts. Preferred shares, common shares I need to update, number of common shares, land which doesn't go on shareholders' equity, what's left of the contributed surplus. I have to update retained earnings for the net income. This happens due to the closing of all the temporary accounts. Total retained earnings at the end of the year. This information would then be used to complete both the statement of changes in equity as well as the balance sheet or statement of financial position shareholders' equity section. In the next video, I'm going to calculate the earnings per share.